Changes in external factors such as interest rates and exchange rates could have negative consequences for entities. Such changes would ultimately affect the cash flow upon settlement. So to protect against uncertain cash flows, entities take out cash flow hedges for recognized assets, liabilities, or for a highly probable forecast transaction. For example, Timeless Limited is a company that sells exclusive watches which it imports from a supplier in Neverland. Neverland's currency is the NEV, which fluctuates drastically. On the 1st of April, Timeless Limited signed a binding agreement to purchase 2,000 watches from the Neverland supplier. The total purchase price was 1 million NEVs. 30th June is the date on which the contract will be settled in NEVs. On 30th April, the shipment arrived at Timeless stores. During the period between the signing of the purchase agreement and the settlement date, the NEV could have appreciated or strengthened against the Australian dollar, which would result in an additional cash outflow on settlement of the debt. Additional information indicated that the spot rates for the different dates were as follows. So to protect against this fluctuation, Timeless Limited took out a forward foreign exchange contract on the 1st of April with the broker to receive 1 million NEVs and to pay $610,000 to settle the foreign exchange contract. The forward rates for the delivery on 30th June are as follows. What would be the journal entries on the various dates? On the 1st of April, Timeless Limited entered into an agreement to purchase the watches. No journal entries are required because the risks and rewards of ownership have not yet passed to Timeless Limited on this date. Timeless also entered into a foreign exchange currency contract or FEC contract on this date. There is no journal entries required since the value of the FEC contract is zero. Note that the FEC contract rate for 1 NEV was 61 cents on 1st of April. This times 1 million NEVs is equal to $610,000. So Timeless Limited's right to receive 1 million NEVs is equal to its obligation to pay $610,000 on the 1st of April. Accordingly, no journal entry is required on this date. On the 30th of April, we need to remeasure the value of the FEC contract. You should note that the FEC contract rate is used to remeasure the value of the FEC contract. The FEC contract rate is 62 cents for 1 NEV. This is an increase of 1 cent. This times 1 million gives us an increase of $10,000. IFRS 9 paragraph 6.5.11 provides an important rule at this stage. Since the inventory of watches has not yet been recognized, the gains or losses from the changes in the fair value of the FEC contract need to be recognized in other comprehensive income. So the journal would be a debit to FEC contract to recognize the receivable from the broker of $10,000 and a credit to equity cash flow hedge in OCI by the same amount. On 30th April, Timeless received the shipment of watches. Thus, the risks and rewards of ownership passed, and this needs to record an increase in inventory and accounts payable. The accounts payable would be calculated using the spot rate, which was 61 cents for 1 NEV. So the journal would be a debit to inventory with $610,000 and a credit to accounts payable by the same amount. IFRS 9 paragraph 6.5.11 provides another rule now that the inventory is recorded. All gains and losses that were previously recognized in OCI need to be reversed and recognized against the non-financial asset, which is the inventory of watches. So the journal would be a debit to equity cash flow hedge in OCI to reverse the $10,000 previously recognized and a credit to inventory by the same amount. Once the non-financial asset is recorded, the journal entries for the cash flow hedge are similar to that of a fair value hedge. In other words, gains or losses from changes in the fair value of the hedged item and hedging instrument are taken to profit and loss. You should now attempt to do the remaining journals for the 31st of May and 30th June. To recap, prior to the recognition of non-financial assets, gains or losses from the remeasurement of the cash flow hedging instrument are taken to OCI. After the non-financial asset is recognized, the previously recognized amount in OCI must be reversed and adjusted against the value of the non-financial asset. Subsequent gains or losses from the remeasurement of the hedged item and hedging instrument are taken to profit and loss. This is the same treatment as that of fair value hedges.